In this video, I'm going to discuss exactly what a stock share price is, what it means, and what sort of determines this price. And if a lot of people new to the stock market, one of the biggest misconceptions is that share price actually means something. The only thing share price means is how much you actually pay to own one share or one unit of stock. So for AT&T, as I've displayed here, it's currently just over $33, and for Google, it's over $1,100. And people hear that or see that and think, wow, Google's over $1,000 a share. They must be worth 100 times more than AT&T, or 30 times more, however that math works out. Probably about 40. So yeah, Google's share price is 40 times larger than AT&T based on share price. But really, does that mean Google is 40 times more valuable than AT&T? Not at all. And the reason for this is something called shares. So basically, the actual number of units of stock varies drastically from company to company. It's an arbitrary number, and a lot of times it changes based on companies either buying back stock or floating stock back out onto the market, whether that's through additional stock offerings or just employees exercising stock options. Shares is a somewhat fluid number. It goes up and down over time, and from company to company, it's much different. So AT&T has 5 billion shares, whereas Google only has 330 million. So Google's share price is so much higher than AT&T. I mean, Google is worth more than AT&T, but it's only about twice as much as AT&T. The reason the stock price is 40 times different is because there's almost 10 times the number of shares, or there's more than 10 times the number of shares of AT&T available as there is of Google. So what we need to look at when determining how valuable a stock is actually something called market cap, and that's basically calculated by multiplying the price per share times the total number of shares. Pretty simple calculation. So we can see Google's worth 377 billion, whereas AT&T's worth 177 billion. So Google's worth just over 2 times more than AT&T. It's not as if Google was 40 times if we're just looking at share price. And if we look at Apple here, and you can see that Google's, costs almost more than twice as much per share as Apple, but Apple has a larger market cap. Right now, Apple's considered more valuable than Google as a company. Okay, so now that you know about market cap and what share price means, we're going to discuss exactly what affects the share price. And the three main things are earnings growth, and revenue, or revenue growth, I should say. So if we're looking at the financial statement, you can click on Financials in Google Finance, and click on Annual Data. We can see that, where are we looking at? Okay, net income. So this is total earnings, and this this value is divided by the total number of shares, and you get earnings per share. And what you can get is something called the price to earnings ratio. Right here, it's 32. And how this is calculated is dividing the share price by the earnings per share. And since share is on both sides of that fraction, it's canceled out. So what you get is a value that can easily compare how expensive a stock is from a price per share perspective compared to its earnings. And this is, a value that you can use to directly compare two stocks. As this is the real price of a stock rather than this. So AT&T is almost 24, Google's a little bit over 30, and the way PE varies from company to company, why certain companies are worth more than others, is primarily due to the growth of either earnings or revenue. So if we look at Apple's PE, it's very low compared to Google's, and basically, if we go to the financials, what this means is that Apple's price per share versus its earnings per share, I'm looking at the quarterly. On the annual, we can see that, let's go back to Google's. Apple's earning more per share than Google and has a much lower share price, and as a result, its PE is much lower. So what's the deal there? The primary reason for that is earnings growth. If we look at Google's annual earnings growth, we can see that they've over doubled their revenue, and if we go down to earnings, not quite doubled, but it's gone up nicely. The earnings per share has climbed quite a bit, especially from especially revenue from last year, 2011, or 2 years ago to the past year. And in the last quarter, we'll see that this is going to go up again. It's going to hit about 60 million probably this time. So when we go to Apple, we can see that their annual data, not much growth going on there. I mean, that's still a solid amount of growth, but you can see the earnings actually went down for Apple, and that's why we're seeing a PE so low. I mean, I think the quarterly data for Apple is going to be really good, and Apple's making good money, so I think that sort of is going to hopefully remedy itself pretty soon in terms of, if we're just looking at this annual data, we see this sort of drop off in growth. Whereas if we're looking at Google, it's a much nicer curve. It looks like, earnings are going to be up here soon. So that's why Google's priced more. So earnings and earnings growth are the two main factors, but some stocks don't trade on earnings. So I wanted to mention Amazon. People see this and think, wow, Amazon's so overpriced. How can they be trading at 1,400, a PE of 1,400? That's ridiculous. And the reason for that is actually revenue. And if we go to the financials, we can see that Amazon is basically reinvesting all their money. They have a very high operating expense, and they pretty much every dollar they pull in, they just spend. So if we're looking at the revenue here, this blue line, it's just a straight line up. And you can see that, 2009, they did 24.5 billion in revenue. And in 2012, they did over 60 billion. So fast growth. And that's what Amazon is valued on. I mean, the idea here is that Amazon's growing, so there's no point for them to try to pull in earnings. It's best for them just to reinvest all their money back into their business. If they're doing that efficiently, revenue is going to keep going up. And eventually, once they've built everything they need to build, then they can draw profit. So that's how price per share works. It's completely arbitrary. Don't really look at it too much. The only thing that's important is that if you only have $1,000 to invest, you're not going to be able to buy a share of Google. That's really the only way it really matters. Whereas, I think I just wanted to address something. Some people are like, oh, I don't want to buy Google because I could only afford to buy a couple shares. Where if I bought AT&T, I could have 100 shares. Makes no sense. A share, it's whether you own 1 share or 10 shares. Like I said, it's an arbitrary number. It means absolutely nothing. Instead, when you're evaluating a stock's price, check out its PE. Check out the financials, see how the earnings growth is going. Things are growing quickly, revenue's going quickly, that's great. So this video is helpful for you. Subscribe for more stock videos.